Hi everybody, welcome back to Super Macro. My name is Elvis. As per normal, sitting opposite me is Jonny Matthews. Jonny, what are we going to discuss today?
Yeah, well, I want to discuss the subpar economic data that we've been seeing recently in the States, what that means for Fed policy, and what the outlook is longer term.
Okay, Jonny, first chart. I see we've got Treasury yields with the economic surprise in city's economic surprise index. Now, to me, it's been fairly clear, and you've mentioned this as well, the data has definitely softened over the last couple of weeks, and that's clearly evident in this chart. But rather than look at it against Treasury yields, as I'm sure you're going to talk about, I just want to look at it against the S&P. You know, we look at the earnings of the S&P this year, I think is something like they're expected to be up 11% this year, 12% the following year. Quarter on quarter, Q2 this year to next year is something like an extraordinary 17%. And that's in the face of data that looks softening. So it looks like the S&P's price perfection and the data's not supporting it. Tell us where we're going from here.
Well, let's be clear about this chart, first of all. This is the economic surprise index. So what this is saying is that analysts, they forecast the economic data, and it's been coming in below their forecasts. Now, for the past 2 years, we've been used to the economic surprises being positive. In other words, the economic data has been stronger than expected, almost consistently. And you can see that by the fact that the red line in the chart has been above the zero level. And so for the first time in this last couple of years, we're now seeing the economic surprises coming in below par. And that's partly because economists have revised up their estimates of US economic growth. They were consistently bearish and they were getting surprised to the upside. But it's also partly that a lot of the data recently has been a little bit soft, on the soft side. Now, I think this is just a bit of a soft patch that the US is going through. It's not the first time that's happened. About 9 months ago, the US also started going through a soft patch. The US spoke about the rates were at the peak and started talking about policy easing. And all of a sudden, financial conditions eased and everything started to pick up again. And then at the start of this year, as you can see with the red line, the economic surprises were positive again. Now, I put the Treasury, the 10-year Treasury yield on there just to show you the impact of these negative economic surprises. They have pulled down the Treasury yield. I actually don't think this subpar data is going to last that long. And a lot of what I'm going to talk about today is why. Getting back to your point about earnings, I think if you look at the health of the corporate sector, it's in great shape. The policy hiking to date has had less impact than it has in the past. In fact, and I've shown that in one of the super macro notes recently, the interest expense as a proportion of company profits is the lowest it's been in half a century. So corporates termed out their debt when rates were low.
Now, this is an argument you've used before, and I've read it in other people's commentary, but this is the S&P keeps on going up. And now, I suppose you would argue NVIDIA are a large reason for that. The last probably X amount of percent move, especially yesterday, you and I discussed the fact that NVIDIA are up nearly 5%, and the volume in NVIDIA was as much as the 10 stocks below that. It was more than the 10 stocks below that added up. So they are a large proportion of what's happening, in fact, ginormous proportion of what's happening. But we've used this argument before, the companies turned out their debt, et cetera, et cetera, et cetera. But is there a level the S&P stops at, or is there a PE that becomes too high a hurdle for the market?
Well, I think the thing is that the reason it's going up is because people want to invest. They're looking at the earnings projections. They've got money to invest. And when I say people, I'm talking about institutions and individuals. That's where they want to put the money. If you look at the performance to date, the S&P's up, over 10% year to date, maybe 11% now on a total return basis. The choice is to put the money into T-bills, which are yielding 5%. Investors haven't had any real serious drawdowns in the S&P since 2022. And so I think there is far less fear of investing in equities at the moment. And we see that reflected in very low levels of implied volatility. There is money to invest and people are investing it. The second thing that I would say is NVIDIA is the poster child for what's going on. We're now a service. I say we. I mean, in the US, is very much a service sector economy. Manufacturing is struggling. We saw that with the PMIs this week. Manufacturing is still struggling, but it's a small part of the economy. Companies are not spending as much on industrial machinery, that kind of traditional capital equipment, and I'll show that in a slide later on. They're spending the money on R&D, intellectual property, that kind of stuff. And NVIDIA really epitomizes that kind of transition.
So the AI trend, what we're seeing now, this AI, I want to call it revolution, transition, or what do you call it, new phase, that's set to continue, and the S&P can go up another 10%, no problem. Is that what we're saying? Because it can, and there's liquidity to back it.
Well, I think you've got to be a little bit cautious. The valuations are high. I believe that earnings can continue to grow. And
well, they're projected to, as you've seen, the analyst forecast for this year, next year, etc. But isn't that the question I have is, I suppose you're always looking sometimes as a trader to fade these moves, but fading these moves has been an expensive expensive for your P&L.
Well, I think it's important to acknowledge, first of all, let's get back to some of the data and the slowdown that we're seeing. So this first chart really,
oh yes,
yeah, this is the labour market, and the blue line, this is the total jobs in the economy. So this is the job openings and the actual employment, the people with jobs. So we saw earlier this week that the JOLTS data showed that the number of openings it's been on a steady decline. Payroll growth has actually been strong.
Very, very strong.
Until just the most recent payroll print for April came off that pace of growth. So you can see that in the blue line, but this is not the first time that the blue line has kind of flattened off for a period.
It doesn't look as though it's flattening off very much,
It's well, the trend is higher, certainly. And then, of course, the red line is the total size of the workforce. So it's the those who have jobs and those who are unemployed but looking for work. So
still shows a very healthy economy, and probably that's not and a labour market that's not in equilibrium yet.
Yeah, I think it's moving into better balance.
Yeah,
and you can point to other indications of some softening in demand for labour. And as far as the Fed's concerned, the Fed has previously said that it saw a softening in demand for labour, and now we saw a payroll print that's slightly lower. Obviously, we don't know what tomorrow's payroll print will be, but it's a fair guess to assume it's going to be similar to the previous months. That's a fair starting point as an estimation. The Fed believes its policy is now restrictive.
It's believed that for quite some time.
Yeah. But we now have a policy, if you look at the overnight rate, it's trading at 5.35%, and headline PCE inflation was 2.7%. So you've got quite a wide gap there. And the Fed has said that policy is restrictive. And so the Fed doesn't want to make the same mistake twice. They called it transitory, when inflation first spiked.
You seem to get. I look whenever I see Powell and someone mentions that word to him. You seem to see him grimace inside. I wish I'd never invented that word.
So the Fed's certainly not going to say this little period of labour market weakness is transitory. You know, they don't want to make that mistake again. I think I believe they'll cut twice this year. I know people have said, oh, there's a chance of a hike or there's a chance of no cut. To me, I think the market is right about this. They'll cut in September and December.
Yeah, it's sort of like the ECB will cut in June, doesn't matter what happens. And I think that he's given enough forward guidance in his own way and been dovish enough that he'll have to do one cut at least, even though it's probably not right to. And even there's an argument that you could say the higher rates are stimulative for an economy whereby people have termed out their debt and got a lot of cash earning 5% and getting a lot of dividends.
Well, absolutely. I think financial conditions are so easy, and we'll see that on one of the other charts, that there isn't really a need for the Fed to ease policy by cutting their funds rate.
So long term, do you see interest rate? Could you make a case that interest rates could be this for quite some time?
Yeah, I do think the neutral rate of interest has moved higher, and there's been plenty of debate about this over the last couple of weeks. But certainly, it's nowhere near as low as it was during that period after the GFC. That brings me on to this next chart. Now, next week, this is up until the end of 2023.
Yeah.
And it shows household net worth in billions. So we're talking of, over 150 trillion in
this
net
is made up
household
most
worth.
of property and then shares and other assets.
It's actually dominated by equity holdings.
Is it really?
Yeah, but everything is clear. That when I say equity holdings, that includes pension funds.
Oh, right. Okay.
And their
401ks.
equity holdings.
Yeah.
Well, 401ks are personal holdings of equities. Pensions, a company pension plan or an individual pension typically is invested in equities. So indirectly, they're holding equities. And you can see that just by, I've overlaid the S&P 500 on the chart. That's on the right axis. And you can see that the changes in household wealth are now dominated by changes in the equity market.
Yeah, and the video.
And the video. And so household wealth, it's basically, it's soared since the end of the pandemic. Absolutely soared. And we only have it to the end of 2023. But if you look at where the S&P is now, you can be pretty sure. I think we get the latest Federal Reserve report on their Z1 and financial accounts. I think we get it next week. And I'm pretty sure that you'll see the first quarter wealth has taken another leg higher.
But the wealth is one thing, but we saw some personal spending and income figures that were, I think, possibly the most disappointing of the ones that came out. Even though they weren't much below expectations, they were certainly lower than the previous month. Do you think that this decline or the shape of the curve has changed for good or for maybe for the next few months?
I think what you mentioned there is part of the reason that economic surprise index has gone as far negative as it has. That was a disappointing set of figures, both on the income side and the spending side. But that's coming off a couple of very, very strong months. January was weak. February and March were very, very strong. I think there was a little bit of pull forward in March of goods spending. Amazon had this 1 week Easter thing.
Sale.
Yeah. The Easter was early this year. It happened, it fell. There was a huge amount of spending on goods that reversed in April. So it could be kind of one-off factors that made the April data look worse than they would otherwise have been. I don't like to just make excuses for the weak data and just look at the strong data, but I think when you step back and you look at the fact that the US economy is still producing job gains, is still producing income gains, wage growth that's running faster than inflation. There is more money going into household income each month. That amount of money is growing, and their wealth is growing. So households at the moment have no reason to crawl into their shell and
Stop spending.
Yeah, stop spending.
It's interesting that when we look at world areas of trade, the US last year was very strong, and the beginning of this year continued on with that strength. But last year, Europe was weak. China was in the doldrums because of the property market, and the exporters were taking a hit as well in Asia. And that's all sort of turned around when the US's data's starting to soften. How do you dovetail the two? Well, I assumed that everybody traded with each other, and I assume if one area is buoyant, should infect other areas.
I think there's a timing thing here. There was a lag. The European the energy crisis hit Europe harder with gas prices and the Russia's cutting off the gas from Russia hit Europe a lot harder. And I think if you look at the cost of living crisis, it really hit Europeans badly. And they've just started coming out of that. Headline inflation dropped below wage growth a few months ago.
Right, okay.
But it's taken time for that recovery in real income growth to feed through into consumer confidence and to spending. But I think we're just at the start of that process now. We're beginning to see signs of life in the European economy. The UK, similar, kind of struggling along. We had, much stronger than expected growth in Q1, and hopefully there'll be a continuation in the current quarter.
But the long view of the UK hasn't been that good since, Brexit, isn't it, really? You've written about that in the note.
Certainly, there are impediments to...
I know the UK's PMIs look better than European PMIs at the moment in terms of the number, but if you look at it since, 20... I think what did you do? You did a piece on that on one of your notes.
Yeah, it's really how far below trend growth the UK has fallen.
When you look at it against the US, which is the US has been virtually back to trend growth, and the US and the UK and Europe are probably maybe 5 or 6 percentage points below where they should be.
I think more in the case of the UK. Yeah. But that's, you could ask, well, why is that? There's various impediments, like, for example, the energy crisis, but also the Fed did a recent study and found all kinds of other reasons. And I'll come on to that in my final chart. Before I do, I just want to show this, which gets back to what I was saying before, how the US economy has changed.
Yeah.
And this is business spending.
It's an important chart because it explains a lot. That you look at weak capex, it's not really weak capex because it's not the same capex as being the way you look at it.
Yeah. We look at, traditionally we've looked at durable goods orders, which are,
Boeing aircraft.
or lumps of machinery for making stuff. And really, in real terms, it's kind of been flatlining for a few years. I mean, if you look at this chart, that green line, business equipment spending on industrial transport, computing, other equipment, machines, all that kind of stuff hasn't really grown. Where the growth is in IP investment, and that includes software, research and development, artistic intellectual property rights, that kind of stuff for entertainment. It's stuff, these days we are a society that spends much more of our income on services than goods. I mean, if you think about your monthly spending on goods, sure, you order a few bits of
a few bits. You've not been around my house recently. A few bits.
But you
can't see the house for the cardboard.
Yeah, but look at how much you spend on.
We'd spend more on service. Well, my wife tries very hard to spend more on goods.
Your Sky Sports subscription, your Netflix subscription, your insurance services, just all that kind of stuff. dwarfs what you spend on goods, really. And so the investment, the company's investment now is into being able to provide services
And
more efficiently.
AI turbocharges that, I suppose.
Well, hopefully that's the hope. But we know that it does. I mean, AI is just brilliant at certain tasks. It's not that
moment.
intelligent.
Yeah. I think you named it as a glorified search engine. Do you still hold to that?
Yeah, I think what it does do is it looks at historic data and finds the best match for what you're trying to do. That is what it is. And all those language recognition skills are looking for patterns that it recognizes.
Oh, we're about to get a lot of angry emails, I think, on the glorified search engine.
Yeah, I'm sure people are going to tell
I'll redirect them to you.
Thank you. Thank you. And finally, just to show how big of an impact this has had, and getting back to your point, the relative performance of the economy since prior to the pandemic. If you look at real growth in absolute terms from fourth quarter of 2019 to the fourth quarter of 2023, the US has grown 8.25%. Canada's done quite well, but if you look at the Eurozone, 3%, and the UK, 1%, that's, total growth. And then you look at the composition of that growth. How has the US managed to achieve so much growth? And most of it is by boosting output per hour. That light blue bar, that is productivity gains.
Productivity gains.
Through investment in these kind of things that I was talking about, intellectual property rights and software development, AI, output per hour has really been, or the increase in output per hour has been responsible for most of the increase in output. Canada, in fact, has done nothing in terms of improving the output per hour. When we look at the other components, Canadian employment's gone up a long, long way. But the hours per employee in Canada have declined, as they have in the UK and the Eurozone.
So the US is just so much more dynamic.
Absolutely. It's got a much more dynamic labour market. And I took this from a recent Fed study. And one of the other things that they were trying to find, what is the special sauce that the US has that's enabled it to achieve that? So what is the special sauce that the US has got?
Yeah. Okay, that's the bit I was going to ask you this question. What makes it different?
So obviously there are these productivity gains, but also much more dynamic labour market. What we tended to do in Europe was to we gave incentives, government incentives, for employers to retain their employees.
Yeah.
The idea was that we wanted to maintain the company to an employee link. We wanted to keep that, preserve that, so that when things got better after the pandemic, people could go back into their original jobs. In the US, they fired 20 million people. When the pandemic hit, hired back about half of those, and then gradually hired the rest.
The government bowed out everybody.
Well, the government basically gave out handouts to individuals so that they wouldn't starve while they weren't working. But what happened was, once it was time to go back to work, there was much greater, what the Fed called, sectoral reallocation of labour. In other words, people got fired from the leisure and hospitality industry. They got a couple of $1,000 in terms of stimulus checks and so on to keep them going. And they took their time to decide what they wanted to do. They didn't necessarily go back to the same job. There was this sectoral reallocation. And the industries with the greatest demand for labour, the greatest opportunity to put that labour to work, were the ones that hired. And so it was a much more efficient way of matching skills to opportunities.
So the unemployed or the people looking for jobs went to the sectors where they were most needed.
Absolutely. absolutely.
But this is a question I'm going to ask you. Sorry, I just while we're on this subject, if you're as a company and you've got a similar company that works over the road from you doing a lot better, you start watching what they're doing to see if you can improve your own productivity skills and make yourself more money. Surely other areas of the world, we were looking at the US, why are they doing so well? Why can't we emulate it? Is it because structurally Europe's a socialist economy?
I think you've hit the nail on the head there. We in Europe have a much more socialist structure to government policies and to our labour laws and everything else, really.
So it just shows you it doesn't work. Does that?
Well, no,
Can I
think,
say that? I don't want to be political, but it doesn't
I think if you
work.
look at this chart, if you look at the if you're trying to say what is it, why is the US so special, and it does come down to productivity. It's like Paul Krugman said, productivity isn't everything, but in the long run, it's almost everything.
Right. Yeah.
And that's absolutely correct. So I think on that happy note, we'll leave it.
Jonny, just before we go, let everybody have their lunch or breakfast or dinner wherever they are in the world listening to this. Tell us the portfolio. How's it going and what are your thoughts going forward? What are you running?
Right. Well, the portfolio for the year to date is up just over 20%.
So you haven't given back any money yet?
No, I like the yet.
Okay.
Well, actually, I've got a very cautious approach. I'm out of the short position in Treasuries. I do want to get back into it. I do think that longer term, we're going to have a curve steepening. So in other words, the Fed cuts rates at the front end and the back end, instead of rallying, instead of yields
Sells
going
off.
lower,
Right.
yields end up higher. Simply for two reasons. First of all, and I've said this previously, the Fed will not drive inflation all the way down to 2% if it means crushing the economy. Just crushing the workforce, bringing unemployment up to 6%. They're not going to do that. I think 3% is the new 2% now. That's good enough. So I think that's one area of vulnerability for the long end. And the second thing is the fiscal deficits. There's absolutely no chance whoever gets in, whether it's Biden or Trump, the deficits are going to stay at about 6% for quite some time. So and until something happens, until maybe we get a Liz Truss moment in the Treasury market.
So far as you're concerned, being short treasuries is a trade you want to have on. It's just a question of the levels you put it on at.
Yeah, I think so. And the timing. Right now, the market is very, very geared up. It's very focused on any piece of data that supports rate cuts.
Yeah.
Now, we're going to get a rate cut from the ECB just after we finish this putting together this podcast. And I think right now the market is pricing in about 2 cuts from the Fed this year, and I think that's correct. I think we will get a cut in September and a cut in December. But where we go from there depends really on what happens to inflation.
If you want to read more about what Jonny does, you can subscribe to the notes at www.super-macro.com. Easy, hit the subscribe button. It's virtually free for 30 days. Take a read of it. There's some sample notes there as well if you want to read those. I highly recommend you do that. There's a whole portfolio update every week, and even in midweek he updates his portfolio sometimes as well. But I must stress it's not investment advice.